Hi again, this is my fifth video and I'm going to talk about the self-assessment tax regime. How does it work and what is the meaning of self-assessment? Self-assessment means a person or an individual need to pay his tax by his own assessment via a tax return. As I advised earlier in my first video that the tax year runs from 6th of April to the following 5th of April. So if a person has a taxable income or chargeable gains, they must be reported to the HMRC via self-assessment tax regime. So this means the person needs to notify to the HMRC that he has to pay income tax or capital gains tax. Notification should be given before the 6 months after the end of tax year, which means as the income tax ends on 5th of April, so notification of self-assessment must be given to the HMRC by 5th of October following the end of tax year. There are various penalties are imposed if a person does not notify to the HMRC within the time limits, and the penalties are actually imposed on the nature of the behavior of the taxpayer, as well as either it is a prompted disclosure or unprompted disclosure. What is the meaning of prompted disclosure? It means if HMRC for some reason is aware of the taxpayer that the taxpayer need to notify about his income tax liability or chargeable tax gains, then such disclosures are treated as prompted disclosure. In all other circumstances, the disclosures are treated as unprompted disclosure. So the late notification penalty can be 30% to 100%, and it can also reduce to 0% depending upon the nature of the disclosure. So when we need to submit the tax return, this is a fundamental question. If a person is submitting a paper return, it must need to be submitted by 31st of October following the end of tax year. HMRC also allows individual to submit online tax returns, and the deadline is 31st January following the end of tax year. For example, for tax year 2017-18, paper tax return must be submitted to the HMRC by 31st October 2018, and online return need to be submitted by 31st January 2019. Any tax due should also need to be paid by 31st January following the end of tax year. Income tax liability, as I mentioned in my previous videos, that they are depending upon if a person is earning non-saving income, saving income or dividend income. I have already mentioned what are the various tax rates applicable on all those incomes. The tax liability is paid to the HMRC, which depends upon the income tax of the year as well as payment on account. What is the payment on account? Payment on account means if a person's tax liability is more than £1,000, then he also need to pay 50% of his tax liability for the following tax year along with his original tax liability. I can explain that in an example. If a person's tax liability for tax year is say £3,000, so on 31st January 2019 he has to pay £3,000 plus 50%, which is £1,500 payment on account for tax year 2018-19 with his original tax liability. The second payment on account will also due 31st July following the end of tax year, which means an additional £1,500 will also due by 31st July 2019. Any payment on account which is paid in the tax year will reduce the person's tax liability in the following tax year. So this is what all the self-assessment tax regime works, and if you require any further information on this, what are the various reliefs available, how we can reduce, how a person can reduce payment on accounts, please contact us on the number which is appearing on the video. Thank you for listening.